Ray Dalio predicted the 2008 financial crisis. Then he predicted that the COVID pandemic would strain the US economy for years to come. And now the 72-year-old billionaire investor who turned Bridgewater Associates into the largest hedge fund in the world is warning that a new economic catastrophe is looming, and he wants you to be prepared. Hello and welcome to our channel, folks. Dalio has sounded the alarm about soaring inflation in recent months, particularly after last month's inflation report revealing that consumer prices have risen by the most in over 3 decades. Following that report, Dalio wrote on LinkedIn that raging inflation was eroding the wealth of Americans. So today, we're here to relay Ray Dalio's take on inflation and what you need to do about it for 2022. Being an investor, Ray Dalio always looks in the rearview mirror to see what lies ahead. If this paradox makes sense to you, then you likely agree with history's view that those who are unable to remember the past are doomed to repeat it. Another way to put this is, you can't determine where you are heading if you don't know where you've been. Dalio's new book, Principles for Dealing with a Changing World Order: Why Nations Succeed and Fail, shows investors how to predict their futures by studying the rise and fall of prominent countries and powerful currencies throughout history. Studying the last 500 years helped him, and here he is sharing it with you to help you understand and cope with what is happening now. In the book, it's pointed out that the chronic U.S. deficits could plunge the country into an inflationary spiral. This is because Treasury buyers lose confidence and the Fed must create vast amounts of new money to absorb Treasury supply. Upon being asked how concerned he was about the inflation rate, Dalio replied, "I'm significantly concerned about it." Inflation comes in 2 forms. There is inflation when the demand for goods and services grows faster than the production capacity, and that's normal cyclical inflation. Then there is also monetary inflation, when a lot of money and credit are created relative to the quantity of goods and services. The US is experiencing both. In assessing how the country's finances will look in the future, we have to consider how high the deficit will be and how much money is produced. There's also a risk or even probability that those holding cash and bonds will sell them to make room for other things. When that happens, the US central bank will need to determine whether it will raise interest rates. This will hurt the economy, and Dalio does not believe they will be able to do so substantially. If they attempted to rectify that by raising interest rates, it would be disastrous for the economy, politics, and the markets. So they will probably have to print more money, which will lead to more monetary inflation. In the end, you can't just add so much money to the system and expect the same value of the currency as before. We now have to ask ourselves, how do we prepare for this particular environment? Dalio's tip number 1: evaluate your financial risks. No matter what happens, Dalio said he has one simple principle for addressing future events. If you worry, you don't have to worry, and if you don't worry, you have to worry. He explained that worrying makes you take a closer look at your own personal risks and makes you more likely to act on them. Among the risks could be your location, which includes the place where you live and work. In Dalio's book, he provides a quote-unquote health index that grades nations based on 18 factors such as debt load, military strength, and economic output. This will serve as a resource for readers to assess risks and create strategies on where to live and invest, and Forbes reports that he plans to launch a website hosting real-time updates of the data. The process of moving is, of course, often a hassle, but Dalio said in financially burdensome circumstances, it might be worth considering. Flexibility is key, he added. As such, he recommended that you measure your financial risks using inflation-adjusted figures instead of today's dollars. For instance, cash in a savings account is probably accruing value at a different rate than other investments because inflation is taxing it. It doesn't necessarily mean you should choose other investments exclusively over a savings account and vice versa. During chaotic times, Dalio said emergency savings must be backed by an appropriately diversified portfolio. Which brings us to Dalio's tip number 2: save and diversify your portfolio. In order to create a strong portfolio, Dalio recommends that you assess your current investment strategy, if you have one, in order to determine how many weeks you could financially survive if you lost your job. It always pays to find out whatever the worst case scenario is and cover yourself from that. Also, make sure you don't have all of your money in one place. As inflation hit a 31-year high in the US last month, Dalio told CNBC cash is not a safe investment. Instead, Dalio recommended creating a portfolio ranging from inflation index bonds as opposed to regular bonds to physical assets such as gold. It's even possible to include digital assets such as cryptocurrencies in your portfolio. Despite years of criticizing cryptocurrencies, Dalio told CoinDesk in May that he totes a small amount of Bitcoin. The reason, Dalio explains, is that it's a hedge bet made for the sole purpose of diversification. I urge those who like Bitcoin or those who like gold to not make it an all or none decision. Dalio's book contains a section on determinants that reminds us of key principles that are still relevant today. Wealth is equivalent to buying power. Without going into too many nuances, let's call wealth buying power to separate it from money and credit. It's important to make that distinction since money and credit have differing values. Money and credit go down in value when a lot of it is created, so having more money doesn't always increase one's wealth or buying power. Real wealth is not equivalent to financial wealth. Real wealth is something that is bought because the buyer wants it, such as a home, car, streaming video service, and a lot more. These things have intrinsic value. Financial wealth is a collection of financial assets that are held for future income and/or sold later to pay for the real assets people want. This type of wealth has no intrinsic value. Currently, there is much more financial wealth that can ever be converted into real wealth, so it must be devalued. Even if your financial wealth increases as it is right now, don't think you are gaining real wealth if your buying power declines. Making wealth is equivalent to being productive. In the long run, the amount of wealth and buying power you have will depend on how much you produce. This is because real wealth doesn't last very long and inheritances don't either. Hence, the importance of continuous productivity cannot be overstated. In societies that expropriated the wealth of the rich, tried to live off of them, and were not productive, such as Russia after the 1917 revolutions, it didn't take them long to fall into poverty. The less productive a society is, the less wealthy and hence the less powerful. As a side note, investing in infrastructure and not in consumption usually leads to greater productivity, so investing is a leading indicator of prosperity. Meanwhile, printing money and distributing it without being productive won't increase wealth. Bear this in mind as you consider the consequences of policy developments. If the money is not directed towards raising productivity, printing money will not make us wealthier. Wealth is equivalent to power. If one has sufficient wealth, one can buy just about anything: physical property, the work and loyalty of others, education, healthcare, influence of all kinds, and so on. The history of the world has shown that those who have wealth and those who have political power have a symbiotic relationship, and that the type of agreement they make between themselves determines the ruling order. These ruling orders continue until they are overthrown by others who then grab wealth and power for themselves. Wealth and power go hand in hand. As an example, in 1717, the British East India Company successfully combined financial capital, commercial capabilities, and military capabilities in order to trade with India's Mughal emperor. It was the beginning of the British colonization of India, followed by the fall of the Mughal Empire and its complete collapse in the 19th century, when Britain exiled and executed the Mughal emperor's children after the 1857 Indian Rebellion. The British did these things in pursuit of more wealth and power because they had the wealth and power to do so. Wealth changes bring power changes, so pay attention to who is handling what to create wealth changes. Wealth decline is equivalent to power decline. There isn't a single individual, organization, country, or empire that has not failed when its buying power was lost. For one to be successful, one must earn an amount that is at least equal to one's expenditures. Spending modestly and having a surplus over time is a better path to sustainability than earning a lot more and having deficits. In history, when an individual, organization, country, or empire spends more than it earns, they are bound to experience turmoil and misery. It's also been observed throughout history that countries with higher percentages of self-sufficient citizens tend to be more politically, economically, and socially stable. Right now, the United States is spending much more money than it earns, and it's paying for that by printing money that is being devalued. In order to improve, we must raise productivity and cooperation. As of now, we're on the wrong track. So that is all the time that we have today, folks. I hope you enjoy this video. If you have questions, please feel free to ask them in the comments below, and don't forget to show your support by liking this video and subscribing to our channel and viewing more of our amazing videos. Oh, and one more thing, do please hit that bell icon on your way out to remain updated about all of our future videos. We'll see you next time.